A new Biden housing rule is coming May 1st that amounts to a $14,000 tax on good credit home buyers and threatens to replay the entire 2008 financial crisis in double time. It's as dumb as it is ugly. Obama's FHA director called it, quote, unprecedented, adding, quote, my email is full from mortgage CEOs telling me how unbelievably shocked they are by this move. The new rule means anybody with a credit score over 680, that's about half the population, or who makes a meaningful down payment will pay $14,000 more on a house, while anybody with low credit gets subsidized. This is, from a risk perspective, bonkers. It is paying people to take on loans they can't afford. It's paying banks to crank out systemic risk, all while literally hitting people with a $14,000 fine for paying their bills on time and for saving up for a down payment in the first place. It is raw vote buying using a social credit system that punishes people for doing the right thing. Moreover, it threatens to replay the 2008 crisis because we've already seen this movie and it ended badly. Going back to the early 2000s, the financial crisis was kicked off by intentional policies that pushed banks to make bad loans. Policies the banks were happy to game since they got all the profits, but they dodged all the risks. In the wake of the dot-com bust, interest rates were yanked down to under 2%. That was the lowest since the 1950s, and they didn't normalize until mid-2008 in the thick of the housing boom. Low interest rates automatically encourage risky loans since they make credit widely available even to risky borrowers. But beyond that, federal policies actually pushed banks to make risky subprime loans. This was bipartisan. The Community Reinvestment Act had been pushing risky loans since the 1980s, and the Bush administration added two big accelerants: the American Dream Act that gave grants and down payments to low-income buyers, and a big push for government-owned Fannie Mae and Freddie Mac to buy up mortgages. Together, these let the banks make high-fee and risky loans and then hand all the risk off to either taxpayers or to destabilize the entire financial system, a system that taxpayers also got to bail out. Now, the banks, being no dummies, went to town. They could charge more to poor borrowers, and they didn't even have to eat the risk. In fact, the banks loved it so much, they sweetened the pot with zero down payment loans, no doc loans that didn't even verify whether the borrower had any income at all. Given the easy terms, they could build in time-bomb terms that would jack rates down the line and almost guarantee a default. Basically, banks promised the moon to desperate people, they charged moon prices, and they handed the mess to we, the taxpayers. How did it end? The banks kept their profits, the rest of us got the bailouts, so banks got paid twice, we got charged twice, the financial system nearly went under, and the borrowers were whipsawed. They were ushered to the gates of paradise and then tossed out on their butt. And we were told never again, and now never is back. So what happens next? Same as last time, risky lending, more bank profits, serving up the next collapse and bailout, all in service to a creeping social credit economy where vote buying breaks the system, whether by stupidity or by intention. All right, we'll be watching. See you next time.